All right, diving right in today. Financial sentiment. It's kind of like, the market's mood. Is everyone feeling good? Are they a little nervous?
Yeah, like that gut feeling, right? Optimism, pessimism, that
Yeah.
collective vibe that hangs over the markets. And it comes from everywhere. I mean, we're talking big investors, analysts, even, everyday people just trying to make sense of things.
And getting a handle on that sentiment. Well, it's becoming less of a that's kind of cool thing and more of a need to know if you're trying to, figure out where things are headed.
Definitely. I mean, sure, the numbers still matter, all those, classic metrics and stuff. But to ignore how people are feeling about the market, that's like trying to predict the weather just by looking at the temperature. You got to factor in the wind, the clouds.
The whole picture.
Exactly. And for this deep dive, we've been going through a ton of research trying to understand, like, how do we actually measure this thing, this financial sentiment? It's a bit fuzzy, right?
Hmm.
But the really cool part is how artificial intelligence, specifically these large language models, are giving us a way to see it much more clearly.
Yeah, forget just, keeping an eye on trading volumes or volatility, although those are still in the mix. We're talking about actually using these powerful language models to break down what people are saying. I mean, news, company reports, even social media, it's a whole new level.
It really is. And the promise is it's a more insightful look at how the market is feeling. And getting at that, the how and the why is exactly what we want to do today. We're going to dig into the strategies behind using these large language models for financial sentiment analysis. What are they actually doing? And the theory behind it all. What makes them so good at, reading between the lines?
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so let's start with the basics. What exactly is financial sentiment? I mean, like in real terms. And why should anyone listening care?
All right, so financial sentiment. In the simplest terms, it's the overall attitude towards financial markets. And again, it's the whole mix: investors, analysts, the public, everyone. Are people feeling pretty good, expecting things to go up? That's bullish. Or are they worried about a downturn? That's bearish.
Got it.
And what's really fascinating is that research has actually shown that sentiment can be a predictor. Like, it can give us some clues about where the stock market might be going. And there's been like a whole progression of research on this. Early studies, they kind of laid the groundwork. Like back in 2007, Tetlock, his work showed that negative sentiment, like bad vibes in financial news, it often came before declines in stock prices.
That's interesting.
And then a couple of years later, 2009, Schumacher and Chen, they actually showed that looking at the sentiment in news headlines, breaking news, that could actually be useful for predicting stock movements. And then boom, social media explodes. And researchers like Bolin and his colleagues in 2011, they found that the overall mood on platforms like Twitter, it could be an early warning sign. Like, it could tip you off about shifts in how investors were feeling.
So it's not just a gut feeling anymore. There's data to back this up.
Oh, yeah, for sure. I mean, Oliveira and others, they backed this up too, looking at platforms like StockTwits. It's not just a hunch. There's like a real connection between these sentiments and what actually happens in the market.
So knowing how to read sentiment, it could actually give you a bit of an advantage.
Definitely. And what's super exciting is that we've seen this huge leap forward with large language models, LLMs, like Kurtak and Germano, their research from just last year, 2024, a great example. They found that using LLMs to do sentiment analysis, it just blew the traditional methods out of the water, much better at predicting market moves.
Wow.
They even put together a trading strategy based on this LLM sentiment, and the results were like really impressive. It really shows how powerful these models can be.
That's pretty huge. So how are people actually using these advanced sentiment readings? I mean, in the real world of finance, what's going on?
Well, for a while now, there's been this trend of integrating sentiment into algorithmic trading models. Like back in 2008, Tetlock and others were already working on this. And then, more recently, Heston and Sinha in 2017.
Right.
And I mean, it makes sense. Think about how much financial text is out there. Articles, earnings calls, social media. It's a fire hose of information, but machine learning can handle that, especially these new deep learning and LLM techniques. They're taking those earlier text analysis methods and just, cranking the accuracy way up.
So we've established financial sentiment, it matters.
Yeah.
And these new language models, they're not just counting up positive and negative words anymore. They're doing something way more advanced. Let's dig into the LLMs themselves. BERT, FinBERT, GPT, all those. What's going on under the hood? How are they able to understand sentiment in such a nuanced way?
The key difference is that these large language models, the LMs, they go way beyond just, looking for keywords. They're built to understand language much more like a human does. They consider the context of the words, how strong the emotion is, even the specific language that people use in the financial world. Imagine the old methods. They can tell you if a room is warm or cold, but LLMs, they can tell you if there's a draft coming from a specific window or if someone in the room is feeling chilly, even though the overall temperature is fine.
So it's not just like profit equals good, loss equals bad. It's more subtle than that.
Way more. Like, take FinBERT. It's an LLM that's been trained, super intensely on tons of financial text. So it can pick up on those little differences in sentiment. Like, is a company being cautious about future growth? Or are they, genuinely excited? Is it a small dip in revenue or a full-blown crisis?
I see.
It gets it. And that's why it's such a useful tool, this deeper understanding of financial language. It's a game changer for anyone trying to get ahead of the curve.
And you mentioned different types of LLMs, like BERT type and GPT type. Let's start with BERT. What's the basic idea that makes it so good at sentiment analysis?
Okay, so BERT type models, and that includes some variations like Roberta and FinBERT, which we talked about. They use something called a bidirectional approach. So imagine reading a sentence, right? And you understand each word not just by what comes before it, but also by what comes after it. That's what BERT does. And that's how it can figure out all those complicated relationships between words and financial text. It's like trying to solve a puzzle, but you can see all the pieces around a particular piece, not just the ones you've already fit together.
So it sees the whole sentence at once to figure out what each part means.
Exactly. And FinBERT, remember, it's been trained specifically on a huge amount of financial documents. So it has this deep understanding of all the jargon, all the ways that sentiment is expressed in that world. And then there's Roberta, which is kind of like BERT, but even better. It was trained on even more data for even longer. And that makes it really good at analyzing structured financial information, like company reports and stuff.
So that's how the specialization helps. Can you give me an example, how does FinBERT's focus on finance actually make it better at understanding sentiment?
Sure, yeah. Imagine you have these two phrases, right? One is, the company announced strong revenue growth despite market headwinds. And the other one is, the company faces strong headwinds despite revenue growth.
Okay.
Now, a basic sentiment model, it might just see, strong growth, headwinds in both of them, and it would struggle, are these positive, negative? What's the overall vibe? But FinBERT, because it's been trained on all that financial data, it understands the nuances. In the first phrase, the focus is on that strong revenue growth. That's the good news, even though there are headwinds. But in the second phrase, the focus shifts. Now it's about those strong headwinds, and that's the problem, even though there's revenue growth. So it picks up on that subtle but really important difference in sentiment.
That's really cool. Okay, so now let's switch gears. GPT-type models, like GPT-4, how do they approach sentiment analysis?
So GPT-type models, and that includes things like GPT-4, OPT, LAM-A3, they use a different method called autoregressive generation. It's basically like, imagine you're trying to guess the next word in a sentence. You look at the words that came before and you make a prediction. That's what GPT does. It builds the text and the sentiment one word at a time. And that makes it really useful for, forecasting how sentiment might change, generating financial text with a specific tone, and analyzing commentary in real time, as things are happening.
So instead of looking at the whole picture at once, it's like it's building the picture one piece at a time, and the sentiment kind of emerges as it goes.
Exactly. It's different from BERT, which is trying to get a sense of the sentiment of a finished piece of text. GPT is all about that process, that flow. How does the sentiment develop as new information comes in? And that's really important in financial markets because things change so fast.
I can see that. Can you walk me through an example? How would GPT handle a news story and figure out how the sentiment's changing?
Okay, let's say there's a headline, right? And it says, stock prices initially fall on inflation fears, but tech sector rallies later in the day. Now, a BERT model, it might look at that whole headline and say, well, there's good and bad stuff in there. I'm going to call it neutral. But a GPT model, it's going to process it step by step. First, it sees stock prices fall, inflation fears, that's negative. But then, as it keeps going, it hits tech sector rallies, and suddenly the sentiment starts to shift.
Fascinating.
And it can even go further. It can put it all together and say something like, even though there were worries about inflation early on and stock prices dipped, things turned around because of a strong performance in the tech sector.
So it's not just giving you a score, it's giving you the whole story, the narrative.
Right, exactly. BERT is great for structured data, things like earnings reports where you want a clear sentiment score. GPT, it's more about that dynamic interpretation, understanding how things unfold.
So they both have their strengths. Do people ever use both of them together?
Oh, absolutely. In fact, the latest research is showing that combining them can be super powerful. Like, imagine you're a hedge fund, right? You could use Finbert to analyze a company's quarterly report, get a nice, precise sentiment score, and then you use GPT-4 to look at the news, social media, see how people are reacting to that report in real time. It's like getting the big picture and all the little details.
This has been amazing. It's clear that these large language models are like a whole new level of sophistication in understanding, how the markets are feeling.
For sure. And it's not just about keywords anymore. It's about understanding the nuances of language, all those subtle cues. And that's giving us a much more accurate and, a much more dynamic picture of what's really driving the markets.
And it's exciting to think about what's next. I mean, even more real-time analysis, maybe bringing in other types of data, maybe even building AI that's specifically designed for the financial world.
Yeah, the potential is massive, and things are changing so fast.
So here's a thought for everyone listening. As these AI tools get better and better at understanding the market's emotions, how will that change the way we invest? Will it make things more stable? Or will it, create new kinds of volatility because everything's moving so fast? Definitely something to think about. Thanks for joining us for this deep dive.